This is Terrence Andre Banks with Information Age Financial Solutions coming to you, talking to you today about real estate. Now, I'm a big proponent of real estate. If you're smart and you have the financial education to do it, real estate is a great avenue to bring wealth and create passive and cash flow income. But I would be remiss if I did not talk about this exceedingly high prices even in today's market. Depending on wherever you're going at, the real estate prices continue to go up, and it makes it harder for the average investor, or not even average. It makes it harder for any investor or even a person looking to purchase homes to actually get in and start at a point. So usually crashes are the best time to purchase real estate. And it seems like whether the energy or the psychic connection is there, real estate to be torpedoed in 2018. And because I'm constantly involved with real estate, I look at real estate deals and things just don't make some financial sense. And sometimes I have to drive a couple of hours just to look at properties, which wasn't, several years ago, I didn't even have to do that. They actually made some financial sense, but the prices just continued going up. So, of course, I was attracted to this article. It's not particularly a website that I go to every time, Birch Gold Group, but the article caught my attention because it's just aligned with my making, especially if you ever been outside and talked to anybody. Everyone's still talking about real estate and they have really no experience in it. So real estate to be torpedoed in 2018. I've done other videos in the past talking about the mall market and malls in itself, and that's commercial real estate. So this article seems to be pointing right to the point, and I'm going to read a couple excerpts from it, but I encourage you to take a look at it. Again, it's Birch Gold Group, real estate to be torpedoed in 2018. Real estate is the #1 form of wealth for most people. However, as the last housing bubble and ensuing recession have shown, real estate is not always a safe investment. In 2006, housing prices peaked before falling to near lows in 2011 in the aftermath of recession. But since then, home prices have skyrocketed to new highs thanks to the federally sponsored low interest mortgages. Interest rates that brings anybody out, because if you can borrow at a low interest rate, you can be able to afford the property. You also can make a great deal in terms of cash flow if you're looking from an investment standpoint. But most people are looking just to purchase a home to get in as their first time home, with the baby boomers continuing to retire and millennials looking for properties. Low interest rates make that environment more accessible. In fact, home prices have risen so fast that Americans have all but forgotten the Great Recession and the foreclosure crisis of 2008 and 2009. Another reason why I'm doing this video is people have forgotten. Today, things are different. Today, home prices are only going up. At least that seems to be the prevailing thought. Or if things were happening under the surface that had the potential to torpedo home prices just like a decade ago. A quick survey of interest rates reveals a hidden danger lurking in the real estate market. Okay, treasury yields on the rise again. That's definitely true, especially the recent news. The Fed is continuing to increase the interest rates because they're based on their economic data. Things are supposed to be better on the mend for the economy, and this is a good time for them to increase. Plus, if you follow the space in the economic space outside of the regular mainstream, the Fed needs a backup plan to when it does fall into recession, and we're overdue, especially with the stock market. So they tend to hike up the rates so they can then pull them back, and that's usually been their method to cool down any recession and kind of stop it in its tracks. Today, it looks like history could be repeating itself. The 2-year and 3-year treasuries jumped on Friday to 2.06 and 2.20% respectively. However, it was the rise in the 10-year yield to 2.66 that is most important to homeowners and people invested in real estate. This rate is the benchmark for the financial markets, and it has the greatest impact on mortgage rates. As the chart below shows, this is the highest level since April 2014 and more than double the historic low of 1.32% that it fell on July 7, 2016. And does a little chart here to show that. Always love charts. Gives a very visual picture. Thus, the corporate bond market, junk bonds, and the stock market have been unaffected by this recent change. The mortgage market is feeling the strain as reported in Wall Street. On Friday, the average 30-year fixed-rate mortgage with confirming loan balances of $417,000 or less for top-tier home buyers, according to Mortgage News Daily, ended at 4.23%, the highest in 9 months. Now, even we're looking at 4.23%, again, this is still extremely low compared to historic numbers. Depending on household budgets, this can be a big effect on people's ability to meet their mortgage payments. A jump from 3.5% to 4.5%, for example, can mean an extra $144 a month in payment for a $250,000 mortgage. That's worth repeating. A jump from 3.5% to 4.5%, for example, can mean an extra $144 a month in payment for a $250,000 mortgage. This payment differential obviously increases the bigger the mortgage and can result in several hundreds of dollars extra in payments each month. Whereas falling mortgage rates tend to increase the value of homes, an increasing rate would do the exact opposite. As interest rates creep up, they force home prices down, which is actually is a good thing because it makes it more accessible for people to purchase at a reasonable rate, because a home is a place to live at. It's not always done for speculation. And it also makes renters more affordable rent as well. And add to real estate market woes, the real estate mortgage rates are likely to grow beyond 4.5% as the Fed continues to hike its rates and long-term yields, catching up the trajectory of short-term yields. Another foreclosure crisis on the way. You don't have to be a rocket scientist to see that the writing's on the wall for the real estate market. As Wall Street puts it, higher mortgage interest rates will likely push home prices down, causing current homeowners to lose equity and possibly go upside down on their mortgages. Under these conditions, potential home buyers will probably wait longer to buy once they see the prices start to drop. This will only accelerate price deterioration as home sellers slash prices, get out as quickly as they can. It's funny, when the prices start to drop, people don't buy, which is, unless you're an investor, which makes no sense, but he's right. This could eventually result in a foreclosure crisis even more devastating than the last one, which was one of the primary effects of the 2008-2009 recession. With the real estate market looking vulnerable to a big drop, is there any other asset that you can buy that has strong potential to appreciate over the next few years? Yes, there is. The stocks, bonds, also at the mercy of high yields. One of the few assets with strong potential to rise in value over the next few years is gold. It's relatively immune from treasury yields and will likely grow in value as the dollar continues to fall. And that's his plug. And I can respect that. Proponent of gold and silver, particularly silver, because of what cryptocurrencies and the space are moving for technology, and it's just an industrial metal. But real estate to be torpedoed in 2018, something to take a look at, and definitely one to watch. So until my next video, I'm out.